Howdy, Jacob here. Today we're looking at Arch Resources in the oil, gas, consumable fuels industry. This is one of the two largest holdings that Mohnish Pabrai has in America. And so I definitely wanted to look at that and kind of walk through the differences between the two. They look pretty similar from a numbers perspective, but there are some differences that I want to point out. Maybe we can say why I like one better than the other. And so we do have similar market cap, 2.2 billion with a 2.1 billion enterprise value, just like uh, Alpha Metallurgical. They have more cash on hand than debt. They are in the production and sale of metallurgical products, operate in two segments, metallurgical and thermal. Okay, been around since 1969. Growth here went down, back up again. 2021 and 2022 had massive revenue growth with a 15% decline in the most recent year. Their margins are, they look as good as Alpha Metallurgical, where historically the margins are closer to about 10%, but recently a bit higher. And again, almost all their expenses are coming from cost of goods sold. Doesn't take much sales, general, and admin and other expenses to run the business. And their current PE of 8.7 is similar to the 6 PE on Alpha Metallurgical. They do pay a dividend, and it's quite a bit higher. So it did jump up very extensively recently, but they're looking at a 3.3% yield. Looks like they do fluctuate their dividend pretty heavily since 2017, depending on their earnings. And so if their earnings were to go down to about 15 P or 15 earnings per share, $15 earnings per share, maybe they would cut that dividend a little bit. But huge return on invested capital historically, huge return on assets historically. Again, income statement, cost of goods sold, a heavy amount of their expenses. Balance sheet has over 300 million cash on hand, cash-like products with 105 million long-term debt, 35 million short-term debt. Very similar balance sheet perspective of AMR. And very similar enough, again, their last 2 years were their best free cash flow by a lot. And it looks like historically their free cash flow was a bit higher than their net income and a little bit higher on a margin basis than AMR. But with their capital X down here, their use of cash, they do buy back shares, not as many as AMR, but they've been paying more in dividends. And so from that perspective, if AMR is truly selling for a cheap price, it makes sense to be buying back those shares rather than just paying a dividend. Because if the company's price were to jump up, 15% a year in aggregate annually for the next compound annual growth rate of 15% for the next 10 years or something, it'd be better to buy back those shares and just pay it back to in a dividend where someone can, maybe reinvest, which would make sense. But, you do get taxed on the front end of that. And then if you were to buy just S&P, you're likely looking at 7 to 10% over that same period. And so it's just all about strategic capital allocation. And to me, it sounds like and looks like AMR is doing a little bit better job, but they look like very similar businesses to me. But let's see from a price perspective which one, or if Arch Resources still looks very attractive. So on the revenue growth side, I think I'm going to do a very similar thing to what I did with AMR, probably 3%, because again, they're going to have capital available to make acquisitions that are hopefully advantageous for the business on the bottom as well, top line as well as bottom line, and then also reinvest back in themselves at these stupendous rates of return historically. With that, again, I think I'm fine with the lower than average PE due to the fact that currently they just buy back shares and pay a dividend with a majority of their capital allocation. So they're although you have a historical high rate of return on invested capital, if you don't actually reinvest to get those rates of return, to me, you don't deserve that premium. If you have a 40% historical return on invested capital, but all you do is give 100% of capital allocation to your shareholders, either through dividends or share repurchases, you're not actually reinvesting to get those rates of return. It's more theoretical that you can get that rate of return. And so to me, that's why I'm putting a premium of not a premium with a 13p and price to free cash flow at the end of 7 years, because I think their growth rate will be below market. And I think although they have that high return on invested capital, they're not really doing anything with it that's that really deserves that premium in my eyes. So again, I'm going to do 10 and 15% on the margins because it's very similar. Share change, they are buying back shares, so I'm not really sure how their share count is going up because it doesn't look like they're issuing that many shares through stock-based compensation, and they're buying back more. They're buying back more shares. So if they do buy back, they're currently buying back only 62 million. In relation to here, you're looking at 23 million roughly for 1%. So really, we're looking at them buying about 2%. The dividend is very high. It does pay 158 million, which in relation to their free cash flow recently is not substantial, but is still a good amount. So for me, I'll probably keep that the same. I think I'm fine with that. Maybe it goes to I don't think it'll go to a 50% payout is what I'm saying. And so I'm fine with it being at where it is. The share repurchases are going to be a bit lower. Maybe we're looking at 20% of capital allocation, leaving about 30% to make acquisitions and reinvest back into yourselves. And it looks pretty similar. I mean, for Alpha Metallurgical, 24% above buy price, 16% above buy price for Arch. So I'm going to have to do more research on both of these businesses, see if these numbers can hold, and see if these might actually be really good investments from my standpoint. Because to Mohnish Pabrai, he definitely has a lot of his American investments in Arch and AMR. And so when someone that intelligent buys a company like this, I want to do more research on it to see if it makes sense to me. And if not, I just won't be buying it. Because again, even if Warren Buffett, Mohnish Pabrai, Lee Lu all own this business, if I don't understand it, I'm not getting into it because again, we don't know why they're in it and we don't know what it's going to take to get them out of it. And so for me, I'm whether the smartest person in the world holds the company or not, I'm definitely not just going to buy it for the fun of it. So I'm going to try to do more research on these two. Maybe I'll do a video that tries to compare the two. Maybe I'll combine them into one if I can get it down to the same allowed time. But either way, yeah, interesting business and looks to me like an interesting price point. So I hope you enjoy the video and have a great rest of your day.